Good afternoon, everybody. Welcome to the second session of today. We just have one presenter for this panel, which is John Minns. John is the director of the Australian National Centre for Latin American Studies. This is a conference theme that he's organized and is very close to his research. So it is with great pleasure that he will be talking to us today about resource extraction and development in historical perspective. And without any further ado, I will present John. Thank you.
Thanks. This paper is, by way of excuses, this paper is at the start of what is probably a very long research project which looks at very long-run historical data about resource extraction and the potential for broader forms of economic development, a long historical perspective, and taking a number of different countries as case studies. What I've done here is to take 7 case studies, and not all of them have I yet collected sufficient data on, but I'll present what I've got and my tentative conclusions so far. The 7 case studies that I've taken are grouped into 2 groups for obvious reasons. The first group, Group 1, is Canada, Australia and Norway. In other words, resource extraction economies which at various points have undergone resource booms, which have had at various points high resources in their export profile and at various points high resources to GDP ratio. And they've managed to become fairly generalised high HDI economies, Human Development Index economies, high GDP per capita. They've tended to become diversified economies with a number of different sources of strength in their economy and become over time less resource dependent. The other 4 that I'm looking at are 4 from Latin America, and they are Ecuador, Chile, Peru and Venezuela. Of those 4, the work that I've done mostly so far has been on Ecuador, and that's because I'm working with Carlos Larrea and his colleagues in Universidad Andina and some colleagues here at the ANU on the Yasuni project, and this is part of my involvement in that project. So it's clear that these 2 groups have had very different outcomes in terms of their historical economic trajectory, with one group clearly being in the high income, first world, if you like, economies, the other at best middle income, with major developmental problems remaining and with a degree of exposure to external shocks related to the concentration on a single export. The reason in part that I've chosen the first 3, Australia, Canada and Norway, is that in a great deal of the mainstream literature about resource extraction, these 3 are commonly presented as some of the most successful economies in using resources over time. And therefore the implication, and sometimes a very explicit notion, is that these economies can be historical exemplars for the Latin American economies based on resources. So a couple of things that I want to say about this. The first is that that's not my position at all. In fact, by and large, this is a paper critical of that position, and arguing that in fact there are things about the first group of countries, in particular the historical sequencing of events, what they had prior to the resource booms, that was absolutely crucial in determining their later trajectory. A few things about what this paper is not. First of all, it's not a policy paper which attempts to suggest what could be done in the Latin American economies. That's an important area, and Carlos mentioned in relation to Ecuador some alternatives to extractivist approaches that I think are very valuable, but I'm not going to do that in this paper. Secondly, while I'm mostly interested in Ecuador and oil drilling in the Ecuadorian Amazon, I've chosen 4 case studies in Latin America which are not just oil. Oil has obviously some differences from other resources, but it also has some significant similarities. What I've done is to choose 2 countries, Ecuador and Venezuela, which are relatively oil dependent, and 2 countries in Chile and Peru, which are dependent on other minerals. Thirdly, the term development, economic development, is always one which creates questions. And in the discussion, no doubt I'll be challenged about that, but I want to try to forestall that by saying I'm not dealing with this question. I'm dealing in a fairly conventional way with things like GDP per capita, things like the diversification of economies, their long-term growth patterns and so on. And obviously that avoids an important debate that has to be had, because development is not just a simple objective measure. Development is development for someone. Development benefits some people and very often disadvantages others. And quite often historically, many of the people subject to what we, in retrospect, call development were actually opposed to the process at the time. Okay, so I want to begin with a review of a fairly standard economic theory that was developed in relation to Canadian economic development, reviewing it in the 19th century, called Staples theory. Two or three important Canadian economists, H.A. Innes, W.A. McIntosh, and later Mel Watkins, were crucial in developing this theory because looking back at Canadian economic history, they saw a series of staples, wheat, fur, timber, and fish, were crucial in shaping the way in which the Canadian economy was formed. But in the process of that, it appeared that Canada also developed a manufacturing sector, developed very high incomes, developed high wages, and so on. And their theory was that there were important linkages between those staples and the other forms of industries which were crucial to Canadian economic success, particularly manufacturing. And they mentioned three key ones, which are backward and forward production linkages. That is, a backward linkage is where, for example, the transport infrastructure necessary for transporting wheat across the Canadian territory can be produced locally and therefore stimulates perhaps a transport industry or particularly a manufacturing industry. A forward linkage where the staple that's produced is then further processed on and creates another industry. In both cases, you can see the process of economic diversification taking place and therefore an economy becoming less reliant on that staple over time. And this appears to be what happened in Canada. The third kind of linkage are demand, total demand linkages, which is essentially that the wages paid to people in the resource sector, in the staple sector, contribute to broader demand in the economy and stimulate the development of local industries for consumer goods, etc. A fourth that's been mentioned more recently are revenue linkages, where states which tax the staple industry can use the revenues from that tax in a developmentalist way to create new industries that hadn't been there before. In the early 1960s, Staples theory came under sustained attack from the dependista tradition and the structuralist tradition, and people like Alberto Hirschman as well also mentioned that in looking at Latin American development over the long run, historical development of Latin America, Staples theory simply didn't seem to work. After all, Latin America had been inserted into the world system on the basis of the export of exactly those kinds of staples. You know, it was going to be the beef from Argentina, the sugar from Brazil, the minerals of gold, silver from Bolivia, etc. All of those things were the way in which primarily Latin America interacted with the world economy, and yet in most of Latin America it did not track along the same kind of developmental path as had Canada or other countries such as Australia. In fact, Hirschman argued that in Latin America the linkages simply didn't work at all. What they did, rather, was that when staples were produced, they simply contributed to an increase in imports of manufactured goods, etc., or imports of capital goods in order to make the staples work, or of luxury goods for an elite which profited from the export of those staples. Hirschman argued that this was at least a part of the reason for Latin American underdevelopment in the long term. The Prebisch-Singer thesis that Carlos mentioned yesterday, arising in the late 1940s and the 1950s, took a different kind of tack on this and argued that there was a long-run trend for the terms of trade for commodity producers producing these staples to decline, and argue a number of reasons for that. Now, the literature on that since the Prebisch-Singer thesis has been mixed, with some people arguing that empirically it's simply wrong, other people arguing that it's correct, but I think the jury's still out. The bulk of opinion is that there is some truth to the Prebisch-Singer thesis. Indeed, grateful to Madeline, who pointed out to me a very recent IMF paper which shows that probably twice as many staples fell in relative price in the long term over the last century or more than rose. So there's some truth, at least in the Prebisch-Singer thesis. But what's clear, I think, is that whether or not linkages such as this could be created, reliance on a single or even a couple of major commodity exports for an economy in the long term is extremely dangerous. To rely on a single price in the world economy for your economic growth is always going to be dangerous. Perhaps even more important than any of those effects is the volatility of commodity prices. in fact, a number of bits of research that have been done on price volatility in commodity prices suggest that it's a much greater problem than the long-run decline in relative terms of trade for resource extractors. And in fact, the oil, which is about twice as volatile in price as most commodities, is an extreme example of this. But this is the long-run movement of oil prices. Extraordinarily difficult to plan. The same thing on a less dramatic scale is true also of other commodities, of minerals, for example. They tend to be extremely sensitive to changes in the broader world economy and swing wildly. In fact, more studies show that price volatility for commodities tends to have increased rather than decreased. In other words, the swings have got wilder, particularly over the last 4 decades, and making it more difficult for commodity producers to plan in the long term. The impact of that is that investors find it very difficult to plan long term or to invest long term, large amounts for the long term, based on those kinds of price volatility structures. If they do invest, and this is both public and private investment, it will tend to be shorter run investments because they can't predict the future of the economy based on these commodities. And shorter run investments will tend to be less riskier investments, but they'll also tend to be lower return investments. And therefore the rate of growth overall for the economy is likely to be lower than it otherwise would be, because the economy is focused on this. I won't go into the Dutch disease phenomenon which Carlos mentioned yesterday, simply that there's an observable tendency in some economies for the appreciation of the currency as a result of export of a commodity to result in other sectors of the economy becoming less competitive, less able to export other goods. But there's another factor, which is that unlike other sectors of the economy, in particular unlike manufacturing and services or even agricultural primary commodities, extracted resources are eventually depleted. And again, Carlos mentioned yesterday, stealing my fire once again, that based on Hubert peak oil calculations, Ecuador, for example, will only be able to continue exporting oil for 2 or 3 decades more. And an economic structure built on that, therefore, is heading for ruin, disaster, in the relatively short term. Already Ecuador's oil exports have declined by about 25% based on depletion of resources. The Yasuni-Itete area, which is the particular project that we were studying that was designed to be protected by the initiative originally put forward by the government and cancelled on the 15th of last month, if that exploitation was to go ahead, it would be in preparation for 5 years and then be in production for just 13 years more before total depletion had taken place. So a very, very short-run benefit for what appears to me to be a very small long-term result. There are also long-term longitudinal studies about the effects of resource richness on countries and their economic growth. Sachs and Warner in 2001 did a study of a large number of economies, and they were actually able to quantify the loss of economic growth from some of them. Venezuela, which is the extreme example, the most resource-dependent, mineral-dependent economy in Latin America, in the 20-year period up to 1990, they reckon had a GDP in the end 14% lower than it would have been if the country had no natural resources at all, no oil whatsoever to export. And a study of OPEC members found that they experienced an average cut on their per capita GNP of 1.3% between 1965 and 1998, quite a long-run period. At the same time as other comparable lower and middle income developing countries had an annual average growth of 2.2%. So quite a stark contrast in resource curse. Moreover, the trend over time in resource-rich countries, especially this century since the minerals boom, has been a failure to diversify the composition of their exports and to lift the level of product sophistication of those exports, in marked contrast to what's happened in the most dynamic parts of the world economy in East and Southeast Asia, where precisely that process of diversification of exports and increasing product sophistication has been the hallmark of their export industries. Now, there are, of course, rentier state theories, which I don't intend to go into, partly because I think I'm not entirely convinced about the rentier state theories. That is, that states which rely on external rents for their income have no necessity to represent their population. Someone turned the phrase around, there's no taxation without representation, to there's no representation without taxation. In other words, unless you're taxing your population, you don't have any responsibility to them. And the spending, therefore, is likely to be inefficient, could well be corrupt, etc. And therefore, the developmental path is likely to be slower and less efficient than it would have been otherwise. A great deal of literature about this suggests yes or no, but it seems to me a somewhat determinist view of how the state operates in relation to these economic stimuli. I'll leave that aside for the moment. But the current context of this century is one in which a significant reaction against neoliberalism has led to the election of a number of left-leaning governments. They are generally more inclined to use state intervention in the economy and to use public policy and funds directly to improve education, health, social services and so on. And resource-abundant countries in this way have actually changed the level of poverty rates, for example. Again, Carlos mentioned in relation to Ecuador, but you can see similar sorts of things in Brazil, Bolivia and elsewhere, that poverty rates have actually come down when such governments have used resource rents in order to increase social welfare. But this new extractivism of the left has come into criticism because it seems to have entrenched the historic role of those economies in the world economy rather than transformed it. So in discussions of this, I've looked at Australia, Canada and Norway as the apparently successful resource exporting, resource dependent economies. Each of these has a high GDP per capita, ranks highly in the Human Development Index, and each of them appear to have solid institutions, transparent institutions, well-established institutions and efficient institutions. I'm grateful to several colleagues for pointing out the importance of institutions, and Tony Bevington did again yesterday in this debate, for the way in which countries deal with resources and transform it into broader forms of economic growth or development. There are long-term studies of this as well. Mailer, Moen and Torvik in 2006 did a study of 42 countries that had more than 10% of their GDP as resource exports over a long period as well, between 1965 and 1990. And they did find that there was a high correlation between high-quality institutions, transparent, non-corrupt and so on, and longer-term economic growth. So I think there's a clear correlation there. On the other hand, I don't believe it's the only factor involved. I think there are clearly other factors to do with the endowment of an economy before the resource boom begins. Let me explain. My suggestion is that the linkages of Staples' theory appear to work in these three developed countries because they already had significant industrial basis on which to be able to produce forward and backward linkages. And importantly, they were wealthy countries and relatively high wage countries. And when resource rents, if you like, flowed into those economies, it was possible via those wages to increase domestic demand, not just for a small group of workers, but to spread throughout the economy, the increase in demand leading to an increase in demand for consumer goods. So the hypothesis to test is that the prior existence of a high level of GDP per capita, a high level of manufacturing industry, and a relatively high wage economy at the beginning of the extractive industry boom is strongly and positively linked to future diversification, long-term growth, and avoidance of resource curse. So what follows is a preliminary snapshot of the situation of each of these case studies at the time of the resource booms. The most readily available data is GDP per capita, because we're talking about data here which can go over, in some cases, more than a century and a half. And some of the data is very difficult to obtain, for example, comparative wage rates, and you have to use qualitative information as well as the quantitative data. So I'll show and present what I have. What I've done is to compare the wealth of those countries, all of these countries, compared to the global hegemon of the time, the most developed economy of the time. And that changes in 1905. Up until then, the UK, Britain, was the highest GDP per capita country in the world, aside from a couple of very small outliers. In 1905, that changes to the US. So what I've done in these graphs is to compare the blue line there, which is the global hegemon, with the extractivist economy, or what was an extractivist economy, over the long period, for as much as I've got data. And I'm sorry my graphs aren't as nice as some others that have been presented in this, but it's the best I can do. Norway. So Norway is the 7th largest oil exporter in the world, and in 2010 it was the 2nd largest gas exporter. Norway is one of the countries most admired as an oil producer around the world for what it's been able to do in terms of standard of living and economic growth. Laura Rival, who writes on Ecuador and other development questions, noted in one of the things that she wrote that one of the people she interviewed said, "We would be a different country if we'd done what Norway did way back in the early 1970s. My suggestion is that Ecuador could not do what Norway did back in the early 1970s, and I'll explain why. 19th century Norway was not heavily industrialised, and it's true, this is often pointed out in the literature, that lauds Norway's handling of the resource boom in the 1970s. However, it was very closely connected to modern industrialising Europe in important ways. It had wide commercial connections with manufacturing networks in Europe. It exported mostly primary commodities, but it also used very sophisticated shipping services. For example, although it was a very small country, in 1875 it already accounted for 7% of the world's merchant fleet. So it had a significant, small, but nevertheless a significant industrial base to be working from. And after it got full independence in 1905 from Sweden, further industrialisation took place in a whole series of forward-linked industries, such as fish preserving, cellulose and paper industries. In 1905, extraordinarily for an agricultural country such as Norway, still primarily, Norsk Hydro was established, and manufacturing industry was connected up to sources of hydroelectric power. The electrification network was one of the first in the world and one of the most efficient in the world. In the interwar years, Norwegian ship owners were pioneers in the transformation from steam to diesel. And after the Second World War, you can see here, in this period of German occupation, obviously there's a major downturn in the economy, but immediately after the Second World War, from about 1950, there's what's referred to until the early 1970s as the golden age of Norwegian economic development, when it started to develop again a small but diverse manufacturing basis, a very high wage economy, and a welfare system, substantial welfare state, which evened out incomes across the country. So in the 1970s, in the early 1970s, Norway went through the boom of North Sea oil, and massive amounts of resource rents poured into the country. I'd suggest that a couple of the key manufacturing industries that had already been established, in particular the shipbuilding industry, were able to benefit enormously from this and diversify the Norwegian economy to make it much less susceptible to shocks that occurred later on in the oil economy. Also, because it already had a high wage system and a welfare state, it was able to do what most of the poorer resource-dependent economies were unable to do, which is to forego the resource income for some considerable period. The pressure of the population for increased living standards, higher wages, to pull people out of poverty that's there, for example, in Ecuador, in Peru, in Venezuela, at the time of their resource booms, didn't occur in Norway in anything like the same way. And therefore it was able to establish a pension fund by 1990, which is now, I believe, the largest fund, such fund, a sovereign fund in the world, about $730 billion, where by law governments cannot touch more than, I think, 4% in any one year. It's possible to do that on the basis of that prior economic development, not possible in relation to, for the other resource-dependent countries that I'm talking about. Australia. Oh, and by the way, when you look at these two graphs, the hegemon and Norway, you'll see this with virtually all of those in the first three group, with Australia, Canada and Norway, that while Norway is below the level of the hegemon, it basically tracks the same path, more or less follows the same path of growth. And you find pretty much the same with Australia. Now, Australia is clearly one of the most developed countries involved in extractive industries. It's the largest producer, it was the largest producer of iron ore, bauxite, rutile, zircon, the largest reserves of brown coal, mineral sands, uranium, lead, zinc and so on, and a top 10 producer of a wide range of other minerals, which I won't go through. It was the fourth largest contributor to Australia's GDP a couple of years ago, with 8% of total GDP. And mining has played a very important part in Australia's development since the middle of the 19th century. In fact, you can date it since 1851, and I'll explain why. According to the data that I've got here of GDP per capita, in 1850, before the first mineral boom that Australia experienced, it was the third wealthiest country in the world after the UK and Holland, and not very far behind either of those. Right back in 1850, it had a higher GDP per capita than the United States, way back then. So it was already clearly a relatively wealthy economy. It was also a high wage economy, almost from the very beginning. What happened, of course, with European settlement in Australia is that the indigenous population either suffered the catastrophic demographic collapse or were marginalised from the mainstream economy, which meant that there was a huge labour shortage throughout the colony's existence, right throughout the 19th century. In fact, the shortage was so severe that it was necessary to pay convicts to work in their free time, something unheard of. And the convicts were being paid at a wage rate higher than British labourers at the time, free labourers back in Britain. Certainly, throughout the 19th century, wages generally for free workers were significantly higher than in Britain. And Australia, perhaps undeservedly, got the reputation of something of a workers' paradise in Britain for this very reason. It was the first country in the world to institute minimum wage laws, and was able to do so, and in a sense had to do so, because to attract labour from Europe, white labour from Europe, was very difficult to do. It was a harder, more expensive, more riskier voyage than going, for example, to America, which is where most people wanted to go. Now, the gold rush of 1851 is interesting, the very first mineral boom that Australia experienced, because it led to a massive rise in wages even further. Employers commenting at the time of the gold rush that it was almost impossible to get free labour anymore, and that skilled labour was extremely expensive. It could almost name its own price. Now, the wage levels came down, but what we see in that period is that the benefits, if you like, of the gold rush are fairly widely spread throughout the population by a general rise in wages, not just in a small enclave of mining development, but throughout the economy, and led to significantly increased demand for consumer goods here in Australia. Perhaps the second reason why Australia was lucky is that its distance from the manufacturing centre of Britain to which it was connected gave it a certain natural protection, and therefore encouraged the development, the growth of local industries to satisfy that high demand. So manufacturing and construction took off throughout the gold rush. They weren't sidelined by it. There wasn't evidence, I think, here of resource curse taking place. And in fact, manufacturing had overtaken mining by the late 1860s. Manufacturing was 17.3% of the Australian economy. Even in 1863, mining was only 10.6%. The gold rush is running out, but manufacturing is still growing very strongly. There are a series of other booms which I won't talk about very much because they're not particularly important. There's a second one at the end of the 19th century which raises the importance of mining a bit. There's another one in the early 1930s which does so again. But even so, to that point, until the 1960s, mining is never more than about 3% of gross domestic product. And it is an economy which is overwhelmingly based either on agriculture and on developing manufacturing. Now, the most recent major increases in mining begin from the late 1960s with iron ore, coal and other minerals, nickel and so on. And its contribution then to GDP rose to about 5% or so. Now, several points should be made about these booms. The first is that despite the booms that took place, Australian GDP only rarely, very rarely, just around here in the late 19th century, tracks above that of the hegemon. but also that by and large it follows the same course as the hegemon. It goes up in the period, during the war. It rises at roughly the slightly lower rate than the hegemon in the post-war period, and on. In other words, if you identify the mining booms that take place here in the early 1850s, here at the end of the 19th century, here a little in 1930, and beginning here in the 1960s, we don't see any particular evidence of a rush of growth into the Australian economy. It follows the pattern of basically the developed economies of the rest of the world. And what's interesting to note is that although we have the idea of Australia as a deindustrialised country, which, and it's true that industry fell to, as a proportion of GDP, to about 10 or 11% by the early 2000s, in a pattern consistent with most developed economies. What's interesting is that even as a share of exports, mining only overtook manufacturing as a share of exports in 2008. Up until then, manufacturing, although it's not talked about very much, still played a fairly important, in fact a decisive role in the export profile of Australia. So Canada. Canada also has a substantial mining sector, making up about 19% of total exports and about 5% of GDP. That began as well in the 19th century. Probably much more important in the 19th century were the agricultural exports that I mentioned before: wheat, timber, furs, if you can call them agricultural, and fish. However, mining was important for a period. Mineral development was important. But I've struggled to get quantitative data about Canada, but you'll see a couple of things about the graph. One is that, again, it follows very closely the general trajectory of the hegemon at a lower level. Canada was actually a poorer country in the 19th century, most of the 19th century, than Australia, for a variety of reasons. But it, by the end of the century, developed a very high wage structure for somewhat similar reasons as Australia. That is, people tended to want to go to the United States rather than to Canada. And certainly by 1868, its wage levels were higher than those of Australia or Britain. So some of the same features of a high wage economy and a high level of demand being established very early in the picture. Also, it had very substantial manufacturing very early on. There was, for example, railroad construction. Railroads were an extremely important driver of manufacturing, and you can see them as one of those crucial linkages to staples to develop a broader base for the economy. The typical large railway by 1860, which is very early, remember the railway age doesn't begin in Britain until the 1840s. So this is 1860 in Canada. The typical large railway chain, the Grand Trunk or the Great Western lines, had the capacity to rebuild and to make their own lines, to repair their tracks, to manufacture their own railroad cars and even their locomotives, and to create, to create a good part of the machinery and equipment used in the manufacturing process. Now, you think in terms of the Latin American comparators, this is nowhere near the case at the beginnings of any of their resource booms. In fact, the Massey Company of agricultural machinery manufacture, it was a very important one in Canada. It rapidly became, it was the first Canadian multinational, beginning in the 1840s. And in fact, within a couple of decades, it was the largest agricultural machinery manufacturer in the British Empire. So this isn't a dominion and an outlier of empire, but nevertheless already developing a very significant industrial structure within it. And there are lots of other examples that I won't have time to continue with. Okay, I better get on to Ecuador. Here we see a very different kind of trajectory of GDP per capita. Much poorer, obviously, as you would expect, nowhere near the level of the hegemon even earlier, but also not following the same track as the hegemon at any point. Now, Carlos mentioned some of the details about Ecuador that were significant, and on a graph which zeroed in more on this period here, so probably looking a bit more dramatic than this long run graph. But petroleum reserves were discovered in the east of Ecuador in the late 1960s and started to be pumped out in the early 1970s. By 1973, there's 76.2 million barrels of oil were being extracted, and GDP growth in what is typical of a resource boom takes off around this period, hitting a top of 8.7%. So a very significant rise, rapid growth of the economy. And while oil was only 1.7% of GDP in 1972, it was 23% of GDP just 2 years later, in 1974. So this is the classic resource boom, very, very rapid inflow of funds into the economy. And we do see an element of Dutch disease happening in Ecuador. I think it's one of the clearer examples of Dutch disease, because agriculture, for example, clearly goes backward in the process. It barely keeps pace with population growth, despite the inflow of funds from the oil boom. And manufacturing also does appear to increase in this period in the 1970s, which is an interesting phenomenon. But I think you have to drill down into the statistics, and I haven't been able to do that successfully yet. But while manufacturing does increase as a proportion of the economy and does increase in terms of total output, it appears to be extremely small-scale manufacturing. There was a government industrial census done in the early 1980s, which listed 35,000 manufacturing firms. But of those, only 28 had more than 500 employees. And 31,000 of them had just between 1 and 4 workers. So what appears to have been the case is, because of the weak pre-existing manufacturing structure of Ecuador, all the oil boom did was to increase the small number of firms that were already there at the beginning, rather than industrial concentration, accumulation of capital, increases in productivity, and so on. And the period after, again, I'm afraid, as Carlos mentioned, the 25-year period after 1982, from here right up to 1997, or thereabouts, that 25-year period was a disaster. Per capita income barely grew. It was a mere 0.7% over that whole period. Now, there's no question that since 2009, with the Correa government, that the revenues from oil have been used to reduce rates of poverty very effectively, and I won't go through the statistics, but urban poverty particularly, but also rural poverty, has decreased significantly as a result of government expenditures in that period. However, what hasn't happened is any diversification of the economy. In fact, arguably it's been the opposite. That Ecuador's fortunes are more closely tied to oil than ever. Now, I'm going to have to wind up, and I said anyway that I wasn't going to talk in detail about the other Latin American examples, but I will just take you through a couple of graphs. There's Ecuador, and there's Peru, and it has a very, very similar profile, very, very similar reaction to resource booms. In a period when commodity prices are high, not as much as Ecuador, because the oil price is more volatile than the kind of minerals that Peru relies on. But what you don't see is any very significant upward trend until very recently, with the latest increase in mineral prices. Now, Venezuela, I could do a whole talk on Venezuela, because Venezuela is very different from the other Latin American comparators, because at a certain point in the 1950s, it gets actually in GDP per capita very close to that of the hegemon. And then it goes into basically stagnation, from which it's pretty much never recovered since the 1950s, despite opening up new oil fields, having vast income from oil over that period. So again, Venezuela seems to me perhaps the best case for a resource curse of anywhere. And Chile is another really interesting case that people argue about a lot, because it seems to be following the pattern, by and large, of Ecuador and Peru for most of this period until the 1980s, when there's a takeoff in growth. Now, some people put that down to the neoliberal reforms of Pinochet, working their way through the system from the 1970s and into the 1980s. But I don't think that's necessarily the case. I think there are a series of reasons for that growth. However, what is very interesting, and the only thing that I really talk about here, is that growth only takes off when copper prices collapse. The copper price, on which Chile is pretty much dependent for its export income in that period, collapses in 1982. And yet we get the growth, and stays down into the later 1990s. And yet we get significant Chilean growth. Okay, so a couple of conclusions before I'll wind up. Firstly, while those who pointed to the success of resource-intensive countries and developed countries have pointed to things like institutions, and I think they may be right in emphasising that, we shouldn't take institutions in the abstract out of their context. These institutions existed and were embedded in societies which were already fairly highly developed capitalist economies, in the case of Canada, Norway and Australia. And that they were embedded in situations where there was already significant manufacturing development capable of taking advantages of the linkages that the Canadian staples theorists talked about. And they were existing in situations where the level of wages was high enough that an increase in wages in one section of the workforce, the mining section of the workforce, were able to flow through to others in the economy, increase the general level of demand, and therefore stimulate local production. So I'm not saying, of course, that extractivist economies can drop mining or oil immediately. What I am saying is that optimism about using extractivism in the long term in order to diversify economies and to become wealthy countries in the long term is probably not well founded historically. Thanks. I was thinking maybe I could tie all four first questions together and just answer one, but I think they're similar sorts of questions about inequality, the ability to fight for wage rises via a labour movement or a socialist movement, and asset distribution, because they all go to questions of class structure, really. And it's true, you do see, I think, a very significantly different class structure. I know less about Canada, but certainly in Australia. What happens, I think, in Australia is you get restrictions on the development of anything like a very narrow oligarchy, as you get in many places in Latin America. The restrictions are largely imposed, or partly imposed, I think, by the fact that the colonising power is the most developed capitalist power. Well, it is the only developed capitalist power at the time in 1788. And through the 19th century, what you see certainly in Australian colonial history is an ongoing struggle between both the British Crown and its local representatives, governors at that point, to restrain the development of something like that kind of oligarchy. The closest thing you have to it in Australia are the squatters. And you see elements of that in early New South Wales colonial history, the struggle, for example, between the governors and someone like MacArthur, who's probably MacArthur of the sheep runs and so on, who probably comes closest to fulfilling the potential of becoming an oligarch. So, for example, the squatters don't get the kinds of rights to the land that they demand. The Crown puts this under some control. Also, it reserves rights for smaller farmers in the countryside. But also because under the conditions of a labour shortage, the state actually steps in and tries to regulate the labour market to prevent extreme exploitation, but also as a way of attracting labour to the colonies. So all of those reasons, you get a kind of a structure in Australia where there's certainly a bigger middle class, no question about that, but also a labour movement which is in political circumstances where it's more capable of mobilising, more capable of organising. First of all, it's in good economic circumstances to organise because of the situation of labour shortage, but the political circumstances also allow it some space. So you get mass labour movements emerging in the latter part of the 19th century, and particularly the 1880s and the 1890s, when you get the so-called new unionism of the large-scale organisation of unskilled workers, well, considered unskilled then, people like wharf workers, timber cutters and shearers, whereas before it had been craft unionism based on high levels of skill, stonemasons and so on, and relatively small numbers of people. So yeah, the circumstances that allow a labour movement to exist in the first place then allow it to bid up the wage price even more, the labour price even more. So again, I think the economic effect of that, as I said before, is if you had a level of wages which starts up here and you get a mineral boom which creates a small enclave, it tends to raise the general level of wages still further. It can't easily be quarantined from the rest. And to sort of go to Carlos's question as well about Ecuador. One of the things, if you have a very low wage economy and you establish an enclave of high wages within it, is that even if you get some leakage from that, so some of the demand slips through to the rest of the low wage population, if it's low wage enough, for example, close to subsistence, then what you get is an increase in spending on things which are essentially subsistence items. So people in the first place will eat more food for some considerable time until their wages rise quite a bit. But if their wages are higher to start with, they're already eating enough, they've already got the absolute basics, then what they will tend to spend on are the things that are most commonly produced by manufacturing industry and that form the basis of large-scale industrialisation. So, yeah, the pre-existing level of wages is very important. And as you say, the exclusion of whole sections of the population from really much role in the market economy at all makes that even more difficult to develop that kind of demand. So, yeah, I think those are critical. Now, what else was I supposed to answer? Inequality and sovereign wealth funds. Yeah, I think that's really clear in Norway that, as far as I can see, there was no pressure on the Norwegian government at all to spend all the wealth straight away. It was already, essentially, they had a welfare state, one of the most sophisticated welfare states anywhere in the world at the time. There just wasn't the huge social demand to absorb all of that revenues. Whereas the temptation for a government of a poor country is, of course, to use it immediately. And not to use it immediately would probably be politically non-viable, be unable to do it. So sovereign funds, I think, typically, or ways of saving the resources, can take place there, or perhaps in the Middle East, in circumstances of either relatively low population and low levels of social demands in some of the smaller oil-rich states. The pressure isn't there, in order to spend it. The mining companies in Australia, I think, spent $22 million on an advertising campaign, which must be the best $22 million they've ever spent about the resource mining and resources tax that was proposed, because they saved billions and billions of dollars had the original scheme gone ahead. And of course, actually, that tax, the super tax, has raised virtually nothing in Australia. So, yeah, that's right. I think arguably in Australia, what you could say is that over the last period of mineral boom, the boom has held up growth in the Australian economy. And of course, you expect any kind of boom, any kind of income is going to keep GDP growth going. And you could argue that saved us from recession in the GFC and so on. I think that's reasonable. But the deeper question is, what transformative effects does that boom have? The transformative effects that existed in some of the earlier booms were much greater in Australia than I think has been in the last boom. On the other hand, I don't think we've suffered huge resource curse effects either because of the existing diversification of the economy, level of skill, etc.
Thank you very much,
Okay.
John. Thank you.
Cheers.